There has never been a better time to learn the waves, right? I've said that before and I'll say it again. What we're seeing now is the start of the big decline across all markets, right? The one that I thought was starting basically last year when we had this move down, which then turned into like another sort of bullish move, which it did do. And it made one more last high, which it did do, and then it started to decline. If you go back through my videos, you can see that that's what I have been saying the whole time. Now, at this point, the trolls are very silent, and that's fine. But there's never been a better time to learn the waves, right? So in my last update, I did say that Bitcoin from that red line, when it was about still around 35,000, I did say that that red line is the end of wave 2, right? And if this is to be wave 3, then obviously it's going to get sharper, right? And as you have seen over the last few days, it has gotten much sharper to the downside. Okay, a lot of people are losing money. Right? A lot of people who think this thing's going to go up forever, they're losing money right now. Okay, so fair enough if you are one of those hodlers, fair enough if you're one of those people who don't really care about small price movements. Well, this one's going to be a big, huge price move to the downside. Okay. Now, obviously, I've mentioned this before that Bitcoin moves along similarly to the Dow Jones or, uh, the euro to some degree. Well, especially like XLM, which I'll get to in a minute. This, what's happening here, applies to all cryptos, right? I know that some people want to get a update on XLM, but this is going to affect every single crypto market, right? So there's no real need, but for the purpose of just answering back to some of those questions that people have, where's the XLM analysis? It's the same thing, right? So I called another top at 40 odd cents because I identified this as a complete wave 2, right? And it was way too choppy to be something that's going to continue to go up, right? Now, initially we thought, yeah, it might, but you've got to use some logic, right? Now, the waves, since then, I've obviously done a lot better analysis with regards to how the euro is behaving and how Stellar and other cryptos, they do actually follow the euro quite closely, right? And as I've mentioned before, this is the start of a major decline for the euro, right? And in times of economic crisis, the euro goes down, right? So in this case, there's probably a lot of problems in Europe at the moment. So as I always say, or as a lot of people do say, the US dollar is the cleanest dirty shirt in the laundry hamper, right? So yes, everything is definitely not looking good, including the US dollar, but it is the safe haven at this point in time. So there's no getting around the fact that well, according to AriasWave, the euro has to go down to at least 62 cents, at least, right? If things get any worse than that, then obviously there's going to be far wider reaching, consequences. But it wouldn't really surprise me if this thing actually goes way lower than what I'm anticipating that it will do. Okay, so that said, I have constantly been updating my Dow Jones interpretations, especially for the long-term pattern. Now, in my upcoming book titled AriasWave, um, my latest analysis for the Dow Jones paints a very precise picture of what the patterns actually are. Now, I know I've given you a couple of interpretations over recent times, They all lead to a crash, but the thing is, what kind of crash are we going to see? That's the thing that's really important. That's the thing that's top priority for me, especially now that I'm writing this book, is to get the analysis right. Okay, and it's bloody exciting. I can tell you that much. When you understand the patterns, the way that this book will explain it to you, I'll give you a quick example of what I'm talking about here. So if I go to the DJI chart, right? So obviously you can see here that the Dow is plummeting. And obviously Apple was one of the last ones to go, which is now starting to decline. This is the very latest AriasWave interpretation of the very long-term pattern in the Dow Jones since, and I've got charts that go back before the Great Depression, right? This is all going to be in my book. But this is actually the case for this market, right? The Great Depression was the end. If you want to think about it in Elliott wave terms, because a lot of people are familiar with it, it's an ending diagonal that started a number of years ago, right? So this is a giant zigzag pattern to the upside. Okay, so what that means is that overall the long-term trend is bullish, right? But we have these boom and bust cycles, and the reason for it is because we are in a corrective pattern long term, right? The long term pattern is a corrective pattern, right? It is more than likely a type 2 expanded zigzag, right? But these waves are only the internal components of that zigzag, right? So I used to think that maybe there was a little bit something else going on with this pattern, but as it turns out, according to the latest, this is what I believe is the most accurate analysis that I've done to date, right? So being the end of an ending diagonal, if you want to call it that, I call it a type 1 week 5 wave move. Okay, so this is wave 3, Great Depression high, and then we had an A, which was another expanded type 2 zigzag to the downside, and then we had a B. So the B bounce was significant, right? And then we had a small wave C, for because this is basically still part of wave 4, right? So you have your A, your B, your C, and then you had a D in here, right? You see this little pattern in here? There is nothing else that this can be apart from another zigzag after that little drop. So we had a C, D, E, right? So this is definitely a type 2 expanded correction, right? Because all corrections are the same, but this is a fractal pattern. So obviously, once you if you decide to read the book when it comes out, it's definitely going to be a lot easier for people to gain access to the book, because it's not going to be purely just the course that's available right now, which I've been running since 2020. um, I believe that this will just help people understand it, reach a wider audience, and who knows, it could really impact analysis from here on out. Or it could just be added to your tools of whatever else you like to use when you analyze markets. So in saying that, we had this wave E pattern that then fell down. So this was obviously the stagflation 70s, where inflation definitely was uh, pretty a big problem, right? So then we had an E, and then we had the final zigzag, which was wave 5, right, of that long-term ending diagonal pattern. So being one of the biggest crashes in the history of the stock market in one day, over 20%, the 1987 crash, in my opinion, was supposed to be far deeper, right? So a lot of Elliotticians and a lot of other smart people did say that that was the beginning of a great decline. But the thing that I find is that obviously there was a lot of attention paid to that, and probably a little bit of intervention from central banks. Um, it's interesting to see how that pattern went from such a big drop to then very, very choppy as it tried to take off again to the upside. So to me, the reason that happened is because it was supposed to go lower, but then it turned out that it didn't. Now, the problem with this is basically that whatever's coming next is probably going to be a lot larger. Like we're expecting the next move down to be a wave E, right? So as you can see back here in this area, which I'll point out to you, right? In this area here, you can clearly see that the correction, it was expanded to the upside, which means that the wave E ended above the end of the previous 5-wave move, or in this case, zigzag pattern, right? And basically it consolidated at the highs, which is why you get this really weird pattern, right? So the C wave was short, and then you had another D wave, and the E wave was like pretty big compared to that little C wave, right? So if you want to look at it like in this perspective, 1987 crash was a C wave, just like that move back here. And then you had the E wave, which was longer, more deeper. And what's coming next, because of the way that this D wave expanded so big to the upside, this has to revert back to the mean, right? So similar thing to what happened back down here in this correction is that, we had a move that basically consolidated, and this whole area, right? Technically, this whole area would be the consolidation point. Very similarly, except a much larger version, because obviously, like I just said before, it's a fractal pattern. And the reason that it's going to, it's the same thing basically, right? Now, mind you, going back in time, this particular pattern, the B wave, lasted for a long time, right? Just like you can say that this particular B wave here lasted a long time, right? And then you got a 5-wave move. A 5-wave move in itself is not a correction. So therefore, it's not possible for this to be just like a wave 4 and then a 5. That's typical Elliott talk, and it makes no sense. So this to me is a B wave. So that B wave, which is the whole entire B wave that ended in 1987, that one goes back like to probably like early 1500s, right? And then before that would have been an A wave as part of the bigger, um, wave B correction in this case. That would have been around the time when the Black Death plague happened, right? It would have been a massive crash that happened back then. Now, here, my expected area for this to fall back down towards is most likely going to be around that rising red line trend line, right? So in a way, it's kind of like, well, it's going to revert to the mean. It's going to correct in a more serious wave E, right? My wave E's I usually make them in purple color, right? So that there will be a very similar thing to this other move where it consolidates before then you get another move to the upside, right? So in my opinion, this whole thing could be just a really large zigzag, and that's based primarily on a couple of things. One of them being the long-term patterns in the bond yields, right? Since 1100 AD, we've had like a pattern that started in 1100 AD and terminated around like the early 1300s. Sorry, no, that's not right. We had a large wave B down in interest rates, which terminated around 1941, right? And then you had C wave, which went up. Interest rates went up to 15 to 20%, and that move was a very short move, right? So to me, it's like over time, this pattern has sped up the rest of the correction, which is why you get this kind of pattern happening toward the end, right? Because you get the consolidation of the rest of the wave B in brackets, right? Which I'll draw it in here, right? First of all, let's not forget to basically put the wave E here, right? And then this whole pattern will end up being, the zigzag, well, part of a larger zigzag. Okay, so now whether or not it's something else, then regardless of what happens, this will definitely bounce, and it'll bounce hard in the opposite direction, right? So, like, for example, when you watch the election in 2016, right? You saw the Dow Jones kind of like move down before it made its like a really big move up, when everyone was kind of bearish, and then it kind of like snapped back like a rubber band action and just shot up. um, this is the wave that is the final wave before you get that massive move up, but on a larger scale, right? So we're gonna likely see a massive bull market after this massive crash, right? And that will then, sorry, that's not meant to be A, it's meant to be a B. That will then complete the B portion of that zigzag, or it could be a wave too. I have reason to believe it is going to be a wave C, and then you'll get a move that goes up for a considerable amount of time, probably one of the biggest stock market rallies in history, right? Before then, that pattern ends and we get another crisis, right? Where the same sort of patterns will unfold all over again, right? Because this seems to be like a repeating thing from the smallest degree to the largest degree, right? And then potentially we might see even worse bear markets and worse crashes in general. So I believe, so basically what I'm trying to say also is that this move down will be a straight 5 wave move down, similar to the 1987 crash, right? Now, whether or not it starts off that fast, well, just take a look back here. Did you see this E wave back here? Look how it started, right? It started off quite choppy, and then eventually, after a little bit of ups and downs there, consolidation, it then dropped really fast, right? So I reckon the same thing will probably happen here. Is that you might get this, just messing around at the highs for a little bit, or it could just be like 1987, and after not too long, it'll just go straight down, right? Now, you'll remember I also put my ones and twos into the previous idea. If you want to check that, I'll link that down below. So basically, if like you zoom in, I did say that that was the end of wave two there, right? Of the smaller wave two of the coming wave three, and also the larger wave one and two, right? So to me, this is basically at the point where we're going to see a third of a third, some kind of big move to the downside. So, you want to call it, um, sorry, give me a sec. You want to call this some kind of head and shoulders pattern up here? Sure, you can call it that if you want. It doesn't really make a difference if you do or not. But if you did, then we've already started to see a break of the neckline, and this is going to go way further down than just measuring from the highs, right? Just measuring from the top of the head to the neckline, and then get your target by moving down. I think it's going to go way further than that, right? As I've mentioned to you in my previous chart just then, this move is just a big part of consolidating at the highs for the long-term pattern of the Dow Jones, right? So if we just go to the TNX chart, the bond yield, sure, it's come down a little bit, but it's probably just going to consolidate, right? Because everything gets oversold, even bond yields, right? So it can go back down and correct, and then just shoot straight past that dotted line, which is confirmation for the break of the previous wave 4 down, right? And as I've mentioned before, um, which is also interesting to note, is that this is a wave D down in interest rates, right? I don't use log for this, um, and basically, this is the end of wave D happened in 2020, and then now we're just going to see a wave E up. I'm not sure how high it will go, but it's definitely, well, most likely it'll coincide with what's happening in all the markets, right? That's the whole point to this. So I expect that to go up, and then after that does go up, it'll come back down, which will coincide with the next bull run. Okay, so just another update on that, just to refresh her, and I'll talk to you in the next video.